Listen carefully, because what I'm about to share could save you from the worst financial mistake of your entire investing life. Right now, silver is playing psychological games with you in the cruelest way imaginable. The price keeps climbing. Your portfolio shows gains you haven't seen before. And somewhere deep inside, you're feeling that familiar whisper telling you to lock in the victory while you still can. That whisper? It's designed to make you surrender right before the main event even begins. You've witnessed the run from 70 into 80, then pushing toward 90. You're checking your holdings constantly, watching numbers dance, and having the identical thought that's running through millions of other minds simultaneously. Once this thing crosses $100, I'm cashing out completely. And here's the trap. That decision sounds rational. It sounds like proper risk management. It feels like the grown-up choice to make. But here's the brutal truth that nobody wants to acknowledge. If you exit at 100, simply because it's a nice round figure, you might be abandoning your position at precisely the moment when the rocket is fueling up and the actual liftoff hasn't even initiated yet. Today I'm going to demonstrate exactly why that's true. No fantasy predictions, no cheerleading nonsense, just the raw mechanics of how genuine forced liquidation events actually operate in real markets, how they develop over time in the physical world, and the one crucial indicator telling me the authentic capitulation in silver remains ahead of us, not in the rearview mirror. Quick request before we dive deep. My analytics show something interesting. A massive portion of my regular viewers haven't actually subscribed yet. If this type of thorough analysis matters to you, smash that subscribe button immediately and drop Max Vault in the comments so I can recognize the dedicated community members. Also, after you finish this video, check the description box below. There are exclusive resources waiting there, including our private community access and membership options for those wanting the premium research breakdowns. All right, let's dig into this properly. First, I want to slow your thinking down and completely reframe the choice sitting in front of you right now. Exiting at 100 feels secure because it represents a mental milestone, not because it connects to the actual mathematics unfolding beneath the surface. Round figures are like emotional candy for human psychology. $100, $200, $1,000 per ounce. They feel like natural stopping points, like destinations on a map. But here's what markets understand that humans struggle to accept. Markets move toward whatever price level is required to resolve an underlying problem. Markets don't reward comfort. They reward understanding the mechanics. And a forced liquidation event isn't just appreciation in value. A forced liquidation event is a compulsory purchasing situation where participants who sold something they never actually possessed are compelled by margin requirements, by risk management departments, by collateral obligations, by pure survival necessity to repurchase that thing at whatever price the market demands. That's not speculation. That's mechanism. Pure plumbing. So the only inquiry worth asking is straightforward. Are the entities holding short positions being compelled to cover those positions yet? If yes, then perhaps 100 is already late. If no, then 100 is premature, and premature exits in squeeze conditions can be extraordinarily costly. Here's the data point that should be permanently etched into your consciousness before you even consider hitting that sell button. According to the most recent commitment of traders data from January 13th, 2026, commercial participants on the COMEX exchange are carrying net short exposure of approximately 113,000 contracts in silver. Each individual contract represents 5,000 ounces of metal. Calculate that yourself. That's roughly 565 million ounces of promised delivery sitting short, 565 million ounces of exposure. Now pause and breathe for a moment because I'm going to provide the context that transforms that number from abstract statistic into a pressure cooker with a locked lid. Registered silver holdings, meaning the actual physical metal sitting in the vaulting system, properly tagged and genuinely available for contract fulfillment, stood at approximately 47.3 million ounces as of January 16th. So you've got roughly 565 million ounces of committed short exposure facing approximately 47 million ounces of deliverable supply sitting on the table. That's approximately a 12-to-1 imbalance. For every single ounce actually available for delivery, there exist about 12 ounces of short promises demanding that same metal. And here's the critical detail most people miss completely. If that short exposure didn't contract during this recent advance, it expanded. 1 week prior, January 6th, commercial net short exposure measured around 559 million ounces. By January 13th, it had grown to approximately 565 million. That is an increase of roughly 6 million additional ounces sold short, while the market price was actively climbing. What does that behavior signal? That is not short sellers running for cover. That's short sellers pressing harder against the gate, desperately trying to keep it shut while the crowd gathering outside grows increasingly massive. I'm stating this clearly right now. That's the pattern you observe before the breaking point, never after it. Now, the popular commentary wants you to believe the capitulation already occurred because silver appreciated rapidly. But velocity alone doesn't constitute a squeeze. Short covering constitutes a squeeze. So let me walk you through what authentic forced liquidation actually resembles using two examples nearly everyone recognizes, but almost nobody has examined properly. Volkswagen during 2008 and GameStop during 2021. And while we examine these situations, I want you to hold one specific inquiry in your mind throughout. What was the precise moment the broader market realized the short sellers were genuinely cornered? Because in both instances, that recognition moment arrived before the vertical explosion, never after it. Let's begin with the one they still reference as the ultimate capitulation scenario. Volkswagen, autumn 2008. Global markets were collapsing. The entire financial architecture was fracturing. Automobile manufacturers were absolutely the wrong sector for optimism. And Volkswagen, a car company operating in an extremely hostile macroeconomic environment, appeared to represent an obvious candidate for bearish bets. Sophisticated funds leaned heavily into short positions, but here's the element that actually mattered. Their bearish thesis depended upon one fundamental assumption, that sufficient freely tradable shares existed so they could repurchase later without triggering an explosive situation. That assumption proved fatally incorrect. Porsche had been systematically accumulating ownership quietly. During March of that year, Porsche acknowledged a substantial position while explicitly denying any intention of pursuing complete control. Short sellers accepted that narrative at face value and continued pressing their bets. Volkswagen shares traded somewhat above 200 euros during that time frame. Fast forward to late October. On October 26th, Porsche released a statement that essentially declared, "You believe you understand the available float? You fundamentally misunderstand it." They disclosed combined control of approximately 74% of Volkswagen through direct ownership plus cash-settled derivatives. Then consider Lower Saxony, the German state, holding roughly 20% additional. Combine those figures, and something terrifying becomes apparent. Over 94% of outstanding shares were effectively immobilized. Only approximately 6% of shares remained realistically available for active trading. But the short sellers collectively needed approximately 12% worth of shares to close their positions completely. Meaning, even if every single available share was offered for purchase simultaneously, insufficient supply existed for shorts to exit. They weren't merely short stock. They were short a stock with zero possible exit. That's when the situation fractured completely. The trading session following that disclosure, Volkswagen shares surged dramatically. Then on October 28th, the chart went vertical. Movement from low 200s to approximately 1,000 euros in roughly 48 hours. For a brief moment, Volkswagen became the most valuable company on earth. Not because their business improved overnight, not because investor sentiment shifted. Because short sellers were forced to purchase and available sellers were scarce. Squeezes don't ask permission. They simply take what's owed. That's the anatomy of forced capitulation. Ownership locks up. Available float evaporates. Short sellers recognize reality too late. And price doesn't trend gradually. It gaps violently. Now, apply that framework directly to silver because the ratio of paper promises versus deliverable physical supply appears worse than Volkswagen. Volkswagen's imbalance was brutal, but represented roughly a 2-to-1 float shortage. Silver is displaying a double-digit to 1 shortage when focusing strictly on registered and deliverable inventory. And unlike Volkswagen, there's no Porsche entity sitting on a concealed warehouse containing hundreds of millions of ounces ready to provide supply and rescue short sellers. Silver doesn't just sit around warehoused indefinitely. Substantial quantities get permanently consumed. It enters electronics, solar panels, medical devices, industrial compounds, and it doesn't return easily or cheaply. So, examining this imbalance, the inquiry becomes clear. What's the equivalent revelation moment for silver? What's the instant when the broader market collectively understands that paper claims are overwhelming the physical pipeline? Because when that recognition arrives, you don't receive a polite advance toward 100. You receive a vacuum. You receive a gap. You receive price discovery punching short sellers directly in the face while everyone else watches stunned. Now let's examine the second historical reference. GameStop during 2021. Different era, identical machinery operating underneath. During late 2020, GameStop was perceived as a dying brick-and-mortar retailer. Short interest had reached absurd levels, exceeding 100% of available float, with various estimates suggesting 140% at peak moments. That means more shares were sold short than actually existed for legitimate trading. Such a situation can develop because shares get borrowed, then relent, then shorted again. It's financial engineering until it becomes financial destruction. Then a catalyst emerges. Not a miracle. A catalyst. Ryan Cohen becomes involved, the narrative transforms. Retail investors begin purchasing aggressively, and critically, the short sellers did not immediately cover. Initially, they dismissed it. They mocked it. They increased positions. They doubled down further. Does that pattern feel familiar? Then the price action began tightening the constraints. By January 2021, GameStop began making movements that appeared insane to anyone unfamiliar with positioning dynamics. Media coverage intensified. Volatility exploded. And here's the element most people forget entirely. The genuine capitulation phase wasn't the initial rally, it was the forced covering window. You witness trading sessions where shares advance 50% or beyond. You witness circuit breaker halts. You witness emergency capital infusions. You witness hedge funds accepting bailouts simply to remain solvent. And you witness a peak that isn't a smooth rounded top. It's a spike. GameStop advanced from approximately $40 to nearly $483 within days once the capitulation phase dominated. If you exited at 100 because it seemed elevated, you captured profit and you still missed the genuine explosion. That's the lesson. Human instinct demands selling when safety finally seems achievable. But squeezes punish safety thinking because the most violent upside occurs after the initial, this already seems excessive reaction. And that's precisely why 100 represents such a dangerous trap, because 100 feels like the finish line. But reviewing actual squeeze history, 100 is merely halfway through the corridor before the door even opens. Now, let me connect this directly to today's situation, because we possess something neither Volkswagen nor GameStop provided with such transparent clarity. Weekly positioning reports published publicly. If a genuine capitulation were underway, you should observe shorts contracting. You should observe net short exposure collapsing week after week. You should observe the participants on the wrong side scrambling toward exits. But instead, we witnessed commercial net shorts expand by approximately 6 million ounces during the specific window I just referenced. That suggests the forced repurchasing phase hasn't become the dominant market force yet. So what phase are we experiencing currently? We're experiencing the preliminary phase, the tension accumulation, the phase where price appreciates, stress accumulates, and institutions attempt managing the situation without admitting the situation exists. That's precisely why you observe narratives about overextension, tops, bubbles, selling round numbers, and the classic secure gains while possible commentary. Because the simplest method for diffusing a potential squeeze is convincing the crowd to exit before shorts are compelled to purchase. And that's precisely why I keep emphasizing this point. Don't allow a psychologically satisfying number to make. Now I want to reveal something that smells like the physical market already recognizes what the paper market attempts to deny. Physical premiums above spot prices. When paper pricing and physical metal stop behaving like the identical asset, the market is screaming at you in unmistakable language. Around January 1st, 2026, with futures contracts trading in the lower 70s at various moments, reports and dealer snapshots indicated actual physical metal in regions like Japan and the UAE trading substantially above those levels. Figures mentioned like 130 per ounce for genuine metal when actually available. You can debate specific quotes and specific vendors, but the point isn't the precise receipt. The point is the spread itself. When screens display one figure and real-world delivery pricing demands something dramatically higher, that is an ordinary premium. That's a structural fracture. And in Shanghai, physical premiums remained consistently elevated above Western benchmark pricing throughout late December. In India, premiums widened. Across various Asian markets, the behavior wasn't traders flipping paper contracts. It was purchasers hunting actual metal. And when purchasers hunt actual metal, they don't do it because they're bored. They do it because they need it urgently or because they recognize obtaining it becomes harder later. Now, there's another layer here that most people ignore because it sounds tedious, but it's actually where the entire situation resides. The distinction between eligible metal and registered metal. If you've never encountered those terms previously, don't worry. I'm going to make it extremely simple. Eligible metal is metal that exists within the vault system, but it's not designated to fulfill futures delivery obligations. It's essentially private property sitting there. Registered metal is the portion that's been properly tagged, formally designated, and stands ready for delivery against contracts. So when people display a chart and declare, "Observe the enormous silver inventory in vaults," you must ask one essential question. How much of that is actually available for purchase? Because a warehouse filled with metal belonging to private owners is not equivalent to a warehouse filled with metal that can satisfy paper obligations. That's why registered inventory matters so crucially. It represents the available float of silver. It's the battleground where squeezes occur. And if registered inventory declines, while paper claims remain massive, it's identical logic to Volkswagen's float contracting while short positions stayed aggressive. The frightening aspect is that eligible can appear substantial and still remain irrelevant, because eligible holders aren't required to convert to registered. They can simply hold. They can refuse. They can demand elevated prices. And the moment the market senses that eligible owners aren't volunteering supply, that's when the paper market begins losing control. Because the paper market only retains power as long as the physical side cooperates. Now, here's a critical detail I want you to remember because it changes how you interpret every inventory headline going forward. The day you observe registered inventory declining sharply while price is appreciating and commercial short position remains enormous, that's not a bearish indicator. That's the fuse burning. And that's why I've been stating repeatedly that the question is whether silver can reach 100. The genuine question is what happens when 100 doesn't attract sufficient selling to resolve the short problem. Because that's how squeezes ignite. The price climbs expecting supply to materialize. Supply doesn't materialize, so the price must climb faster. Now let's address the elephant in the room. What if they settle in cash instead of metal? People mention this like it terminates the story. It doesn't. Cash settlement isn't a magic eraser. If the system forces cash payment instead of metal delivery, it's essentially acknowledging that metal is scarce. And once the world believes a market is settling cash because it cannot deliver the underlying commodity, the paper price loses credibility entirely. And what typically follows is one of two outcomes. Either physical goes into its own premium-driven market and decouples further, or a new venue becomes the center of price discovery. In other words, even if regulations get modified, scarcity doesn't evaporate, it merely migrates. And migration is precisely how old pricing systems collapse. Now I'm going to state something that will make you uncomfortable, but you need to hear it clearly. The voices telling you to exit at 100 frequently aren't analyzing capitulation mathematics. They're managing your psychology. Because if sufficient retail holders offer metal at 100, it provides supply at the precise moment shorts need it most, and that postpones the squeeze, which is convenient for the side holding short positions. So whenever you encounter a confident voice declaring 100 represents the peak, ask them specifically based on what mechanism, based on what covering data, based on what inventory reality. If they cannot answer that, they're not conducting analysis. They're telling stories. And stories can be extraordinarily costly. Now, I want to do what mainstream commentary almost never does. Define what covering would actually resemble in silver. If genuine covering initiates, you'll likely observe several things aligning simultaneously. You'll observe the commercial net short position declining week after consecutive week. You'll observe open interest beginning to fall even while price is appreciating because positions are being closed, not merely rolled forward. You'll observe lease rates and short-term tightness indicators spiking because people are scrambling for metal immediately, not later. You will observe backwardation deepening where near-term physical commands higher prices than future delivery because urgency becomes the premium. And you'll observe dealers, refiners, and wholesalers behaving differently. Longer delivery times, elevated premiums, no quotes available, and outright rationing. And then when that begins, you'll face the most dangerous day in the entire sequence. The day the price advances so violently that your brain screams, "This is the top," even though the covering data hasn't even finished collapsing yet. That day is when most people sell. And that day is precisely why the largest profits are captured by people who established their plan before the fireworks started. Now, a viewer asked me something recently that I think many of you are quietly wondering too. They asked, if this setup is so compelling, why haven't the shorts already lost control? Excellent question. And the answer is because paper markets can be managed longer than you'd expect, especially when most participants trade paper and never request delivery. If 99 people trade a claim and only one person demands the actual thing, the system survives. But if that ratio shifts, if industrial users insist on physical delivery, if large purchasers start demanding bars, if trust fractures, then the system must confront reality. And reality is straightforward. You cannot deliver 12 ounces when you only possess one. You can delay it, you can discourage it, you can modify incentives, but you cannot solve it without price adjustment. That's why price is the final arbiter. Now I can already hear the skeptical comment. COMEX will never actually default. Okay, let's discuss how systems protect themselves, because the system doesn't require a dramatic default headline to acknowledge stress. It uses gentler tools, margin requirements, rule modifications, position limits, cash settlement incentives, delivery delays, and we've already witnessed the classic playbook in action. During late December 2025, the exchange issued guidance that effectively increased the cost of maintaining silver futures positions. Higher margin requirements. What happens when margin jumps? Smaller traders get forced out. Leveraged long positions get liquidated. Price pulls back. The headline becomes, "See, bubble burst?" But margin increases don't create new metal. They don't erase the long-term supply deficit. They don't delete the short exposure. All they accomplish is removing weak hands from one side and purchasing time for the other side. And purchasing time is precisely what you do when trying to prevent a public capitulation event. So a pullback following a margin increase doesn't disprove the squeeze. It can be the exact clearing process that establishes the next leg because it flushes leverage and leaves behind the holders who aren't easily shaken. Phase 1 is where we are currently. The grind near 100, where headlines scream top. Weak hands get shaken out and shorts still act like they can control the tape. Phase 2 is the catalyst. One ugly little fact becomes public. An inventory shock, a delivery hiccup, a rule adjustment, an industrial purchaser speaking publicly. And the crowd suddenly realizes this isn't just a rally. It's a supply problem. Phase 3 is the capitulation phase. Covering starts genuinely, not polite covering, forced covering. Margin calls, risk departments, liquidation, panic bids. That's when price stops trending and starts gapping. Phase 4 is the spike, the fast, chaotic blow-off where people who exited early stare at the chart like it's malfunctioning, and the top arrives and passes quicker than anyone anticipated. Then comes the reset, a new base that remains higher than where everything started, because structural scarcity doesn't vanish just because volatility cooled. Now here's the moment where I'm going to look you directly in the eyes and ask you to be honest with yourself. Why did you purchase silver initially? If you purchased it as a quick trade, then you require a plan for volatility. If you purchased it because you believe currencies are being diluted, supply chains are tightening, and real assets matter, then selling at a round number because it feels satisfying isn't a plan. It's an impulse. And impulses are expensive in capitulation environments. Now I want to address another aspect people ignore, the industrial reality. Silver isn't just a metal you stack in a safe, it's also a critical input material. Solar panels use it, electronics use it, high-end manufacturing uses it, medical and chemical applications use it, and while investors can decide to take profit, factories can't decide to stop needing silver without completely redesigning their production. So if price spikes, industrial users don't simply disappear. Initially, they panic purchase to secure supply, then they search for alternatives, then they redesign if they can. That process requires time, meaning in the early phase of a squeeze, industrial demand can actually intensify the movement. But that's why physical tightness matters so critically. Because if physical tightness collides with forced short covering, you get the kind of movement that feels impossible until it's already happened. Now I want to introduce one more angle that often functions like a smoke signal. Sophisticated money behavior. You don't have to worship institutions to observe their actions. When someone takes an unusually large concentrated options position, especially on mining companies, especially with a short time frame, it can be an indication that somebody expects volatility. There were reports of very large call option purchasing in silver miner related products around late December 2025, with sizes that appear abnormal for standard hedging activity. And again, I'm not suggesting you copy trades. I'm suggesting that when big money pays substantial premium for upside exposure, it often suggests they believe the movement isn't finished. Now here's the part where I'm going to keep it real and keep it responsible. This is not financial advice. I'm not inside your account. I don't know your risk tolerance, your time horizon, your bills, your psychology, but I can tell you what I'm observing and how I'm thinking about it. If you're holding physical outside the system, your biggest edge is time. You are not forced to sell because of a margin call. You're not forced to sell because your broker changed the rules. You can hold. That doesn't mean never take profit. It means you don't let a cute number dictate your entire decision. If you're holding paper with leverage, you need risk management because leverage can get you liquidated even if you're correct. So the what should you do depends on what you hold and how you hold it. But here's the universal point. Selling at 100 purely because it's 100 is not analysis. It's superstition. Now I want to make this interactive for a moment because your comments teach me what the community is thinking. Question 1. If silver touched 100 tomorrow, would you honestly sell or would you hold for the capitulation phase? Question 2. What would make you change your mind? What data point would convince you the genuine squeeze is underway? Drop your answers below. And if you've had success in any market, silver, gold, real estate, business, share one lesson you learned in the comments too, because your story might be the thing that keeps someone else disciplined. And speaking of stories, quick creative sidebar. If you want silver-related success stories, real people, real outcomes, there's a link in the description to another channel we appreciate. Go subscribe over there too, and observe how people have been turning strategy into results. Now back to the main thread. A lot of people are waiting for the perfect peak to sell, but squeezes don't hand you a perfect peak. They hand you chaos. So instead of asking, where's the top? The smarter question is, has the capitulation phase started yet? And the best public clue for that is still positioning. If commercial shorts begin shrinking aggressively while price is appreciating, that's when the squeeze is consuming them. If registered inventory keeps draining while open interest stays huge, that's when stress is rising. If physical premiums explode while paper lags, that's when the disconnect widens. If the exchange changes rules repeatedly, that's when the system is trying to contain something. Those are the breadcrumbs. And yes, rules can change. Exchanges can hike margins, nudge cash settlement, and do whatever they can to purchase time. That's exactly why many people keep their core position in physical, because scarcity and counterparty risk are two different battles, and physical helps you fight both. Now, let me be specific about what not selling at 100 actually means in a mature plan. It doesn't mean you never take profit. It means you think in tranches. You think in slices. You think in, if this happens, I do that. The worst plan is the single line plan. I sell at 100 because single line plans are brittle, and brittle plans break in violent markets. Now I'm going to say something that might upset the quick profit crowd. If the structural setup is as tight as it appears, the market might not even give you a clean 100 exit. It might jump from 98 to 112 in a blink. It might gap over your limit orders. It might halt. It might do the exact thing squeezes do. Move too fast for most people to execute their nice and tidy plan. That's why I keep calling 100 the launch pad. It's where everyone thinks the story ends, and that's why the story may begin there. Now remember what we learned from Volkswagen. The squeeze wasn't the early movement. It was the float-locked realization. And remember what we learned from GameStop. The squeeze wasn't the first rally. It was the forced covering window where the wrong side had to purchase into a vacuum. So ask yourself, have we had the float-locked moment in silver yet? Not fully. Have we had the forced covering collapse in commercial shorts yet? Not based on the data window discussed. So we are not in the squeeze climax yet. We are in the build-up. And build-up is where impatient people sell. Now let's talk about timing without pretending we can predict the exact hour. If registered inventories keep bleeding, if industrial demand stays sticky, and if the paper market keeps carrying massive short exposure, the break moment becomes more likely as time passes. Because every day the system can manage is a day they try to manage until they can't. And when they can't, the price doesn't ask permission. Now, I want to add one more thing that matters for you as a viewer, not just as an investor. We're building a community here that values original work. And I'm not going to rant, but I will say this politely. I see a lot of copycat content out there recycling the same talking points with no real analysis. So if you want to support the original work, do two things. Subscribe and like this video from Max Vault AG. It matters more than you think. And if you want the deeper research and the members-only updates, yes, we now offer members-only videos regularly. These aren't recycled clips. There's a separate team working behind the scenes to build deeper, more researched breakdowns that are only for premium members. If you want access, hit the join button or use the membership link in the description. Now, before we wrap, let me hit the simplest summary in plain language. A real short squeeze has a signature. Short positions start shrinking fast because shorts are forced to buy. In silver, the numbers we're referencing show commercial short exposure not shrinking, but expanding in a key window. That suggests we haven't entered the forced covering phase yet. So selling at 100 because it's 100 is like selling a squeeze candidate during the warm-up. It might feel smart, but it's often when the biggest move is still ahead. And I'll leave you with this. If silver is really going to squeeze, it will not be polite. It will not be slow. It will not give you time to call your friend, check your chart, and decide later. It will move like a gate slamming in a crowded corridor. So your plan has to exist before the movement, not during. Now tell me in the comments. Are you aiming to sell at 100, or are you holding for the capitulation phase? And what's your exit strategy if the movement goes vertical? And if silver went to 150 in a week and then dropped to 120 in a day, would you panic sell, or would you recognize it as squeeze volatility? Stay sharp, stay patient, stay ready. Thanks for watching. Take care of yourself, take care of each other,